So welcome back to the vlog. Been gone for a little hot second here. Welcome back to the vlog. It's been a little minute, but basically I am going to finish what I started. So I'm gonna pick up same book and literally just exactly wherever I left off before. Discipline fell off a little bit there for a moment. My actual trading has gotten a little bit better. So I've seen some improvements there that I'm really happy with. But yeah, I definitely still want to continue the education portion of it. That's ongoing, that's always. So even if I fall off a little bit from the routine or the disciplines that I'm trying to stick to, I will always come back because my end goal remains the same, and the small, the incremental things that I need to do along the way to make the larger achievements happen, they're never going to not matter. They have to happen. And no matter how slow the growth is, definitely want to take advantage of the compound effect. So whatever we've worked on previously, continue to build on that and move forward, even if you do fall off even if you do fall off track a little bit. All right, so jumping back into the same place, and we're gonna jump into over trading. All right, let me get comfortable. All right, I think you guys can still hear me. This should be fine. Yeah, I'm relaxed. I gotta chill. I gotta get comfortable. All right, cool. Over trading. By nature, day traders place a high number of transactions. Whether via a commission or spread, the costs associated with these transactions can add up quickly. Overtrading occurs when a day trader makes an excessive number of transactions in relation to their financial performance. It is often the single most expensive mistake for a novice day trader to make. The mistake is frequently propelled by a combination of confidence bias, whereby day traders overestimate their abilities to beat the market, and compulsive behavior, whereby day traders strive to take advantage of each and every opportunity that presents itself. Day traders can avoid overtrading by following a system, the same way that they could avoid the kinds of problems underpinned by rampant emotions. Rather than exploiting every single opportunity that arises, traders can use trading systems to focus on trades with the most favorable risk-reward profiles. These dynamics can help improve the profitability of each trade and reduce transaction costs over time by making fewer trades. Trigger trouble. Day traders often have trouble pulling the trigger on a trade since there's often a lot of money on the line. By second-guessing their decisions, trigger trouble can lead to worse execution prices and more missed opportunities. These concerns are related to execution issues, whereby a day trader immediately regrets his decision after placing a trade. Day traders can avoid trigger trouble by building trust into their trading system or strategy. The best way to build trust in these systems is by backtesting with historical data and starting small when executing trades in live markets. Building confidence helps reduce pre-trade anxiety and ensure that trades are executed at the best possible moments. When trading without a specific system, day traders can build their confidence by paper trading with fake money in real markets, and then start small when they actually use real capital. Exiting. Suppose that a day trader established a position that has risen significantly over the past 15 minutes and reached a predetermined exit price. Day traders are often tempted to ditch their plans and let the trade run. The problem with deviating from these plans is that it creates a high level of uncertainty after the exit point is ignored. If the stock moves lower, the day trader may be tempted to try to recoup the losses by holding onto the stock longer if the stock moves higher. It becomes difficult to pinpoint any price at which to lock in profits. Day traders can avoid these problems by establishing clear exit points before they even enter a trade. These exit points include both a stop loss, the uppermost amount that a trader is willing to lose, and a take profit, which is the point at which they plan to sell. Some day traders who do let profits run may also set up trailing stop loss points, which automatically adjust higher as the stock price rises, so as to lock in profits that fall below the new stop loss point. Addressing common issues. Most psychological problems faced by novice day traders can be avoided by adhering to the adage. Where the fuck was I? By adhering to the adage. All right, this way. Plan the trade and trade the plan. In other words, day traders should focus on developing and executing an investment strategy rather than executing individual trades if they want to avoid making emotionally charged decisions. By doing so, they can focus on the bigger picture and remove as much human error as possible. Unfortunately, even the best systems experience periods of decline known as drawdowns. Most novice day traders will be lucky to break even during their first year. The prospect of losing money or just breaking even after expending a significant amount of effort for an entire year is disheartening to many novice traders. It's therefore important for day traders to develop strong support systems, particularly in the context of family and relationships, which can help them handle drawdowns. By expecting that they would either lose money or break even, day traders can set the right expectations from the get-go and focus on improving over long term so that they may reach their financial goals. Day traders suffering losses may be tempted to look toward others to provide them with the knowledge or systems that they need to beat the market. In reality, the skills needed to succeed at day trading are learned skills that become a part of the brain's basal ganglia, where instincts are developed. The steep learning curve associated with day trading is a necessary step in the process towards becoming a consistently profitable trader in the market by getting a feel for how the market works. Quick recap. Psychology plays a large and underappreciated role in the life of day traders. Given the many cognitive biases affecting humans in general, of course, many of these same biases carry over into the way that we behave with money. Arrogance in the form of overconfidence bias can be dangerous since traders may engage in overtrading or placing trades that aren't well thought out. To avoid it, traders should stick to a specific set of rules when trading. Rule bending can be problematic in that it places the day trader in unfamiliar territory. The fix to rule bending is simply to avoid changing the rules under any circumstances and stick to the trading plan. This is so incredibly difficult that I think for me to even get to the level of consistency that I'm at right now with not executing a trade that goes against my trade plan, I have probably not been able to do this for longer than 2 days of day trading. And even with significant evidence, right? If you log all your trades, which I'm logging all my trades, and I can look back and I can see when it's working, like when my trading strategy is working and when it's not. And it's very clear. Because I can see like what percentage I'm winning for trades. I can see how many trades I'm winning versus how many I'm losing. I can see what my entry criteria was, what the market looked like, what my thinking was, what made me actually pull the trigger to enter and or exit. And even though your strategy is going to encompass some losses, if you have a strategy that you know wins, at least from my experience, when I follow my strategy, I have the best like overall outcome, the best overall like average, and my trading wins. So this is very true, but it's actually very difficult to stick to. Very, very difficult. And I've been trading like over a year now, pretty much on like a full-time basis. There have been like short periods here and there where I didn't trade, maybe for like a couple of days or maybe for like a week or something a couple of times. But for the most part, for the past year, I've been trading. I trade every single day, right, for hours. And it is very true. Like you can't, like for example, when I learned Amazon, right, like I got a course, I got a course and I followed what they told me to do step by step, and I got great results. In terms of trading, there's tips people can give you. You can watch and see what people do, but the best thing to do is to really dive deep. Once you get a good foundational knowledge, like you really need to dive deep into your own trading. Like, dude, get the fuck out of here. Like honestly and truly, you just need to trade. You need to get the losses under your belt. Like you need to get the wins under your belt. You need to get the feel of the market. You need to see how you respond to wins, to losses, to different kinds of market movements, whatever. But there's nothing that can beat the actual firsthand experience of it. Like you have to have it. You have to have that feeling for it. Otherwise, you may as well just like join one of those groups where they post whatever trades they're gonna do, and you can just copy trade. But I mean, the rigmarole of just going through the experience of failing, having success, having it ripped away from you, learning the discipline, there, I don't really see there being anything that could replace that in learning how to trade. Denial is a common and troublesome emotion experienced by many day traders, whereby they fail to acknowledge losses. This is definitely something I experienced too. The best way to avoid failing prey to this is to maintain detailed records and objectively review them every week or month. And I totally agree with this, and this is why I write all my trades down now. And I would like to get back to recording my trades as well. I'll start doing that again soon, because I just think that's helpful for me, like to be able to see every single thing. I want to see everything that I'm doing when I trade. I want to be able to pick it apart as meticulously as I want, so I can learn the most from it, and apply that to how I trade in the near future. But keeping a record is very important, because your brain might really hold on to your wins, and I mean, seriously, emotionally, you may be painting this picture inside of yourself that like from your perspective, that you're trading well, because you're simply in denial. So you're not really keeping like mental track, like a mental record of your losses. You're discounting them, and then you're giving too much credit to your wins. And I've done that a lot. So when you keep everything written down, it's all objective. You can't lie to yourself anymore. You can see exactly what your win rate is, your loss rate, and you can see what the consistency of both is. And it's really important, unless you're going to end up building your trading strategy on something that's not even true. Like, you need to objectively understand what your performance level is. Trading should be a largely non-emotional process, but the involvement of money makes this nearly impossible. As with many of these issues, the solution is to stick to a trading plan and focus on changing the plan instead of changing the trade. Traders are often tempted to manipulate a trade after it's been placed against the advice of their trading rules. In many cases, these changes can prove costly and could have been easily avoided by maintaining a hands-off approach. Very true. I've had a lot of trades where I win them and I feel like I left money on the table, so I jump out of the trade, but I feel like I left money on the table, so I jump back in the trade thinking like it's still gonna keep going, and then I literally end up losing everything that I just made in the trade that was like perfect, that was executed exactly the way it should be based on my trade plan. And your emotions of just being greedy and wanting more and thinking that you're just just kind of discounting the risk of jumping in the market, and next thing you know, you've lost everything that you just won, and hopefully not more. Executing trades is often the most stressful part of day trading, since money is on the line. A common way to avoid execution problems, which could lead to opportunity costs, is to automate trade executing using a trading system. Detachment is a common psychological strategy to deal with anxiety, but it can be very costly when it comes to day trading. As with many other things, the best way to avoid detachment is to automate as much of the process as possible. Overtrading is a common tendency among day traders, whereby they place an excessive amount of trades due to overconfidence or trying to recoup losses, which can lead to losses and high commission costs over time. Trigger trouble happens when day traders have a hard time executing trades without hesitation, which can be avoided by focusing on following a system rather than on profiting from each individual transaction. Exiting a trade can be tricky for day traders, given the tendency to hold on to losers and sell winners quickly, when actually the best course of action is to cut losses short and let winners run in order to maximize risk-adjusted returns over time. So true. There are many other important psychological factors when it comes into play when day trading, but the good news is many of them can be avoided by developing a plan and following that plan without making any impulsive changes to it. Yeah, super important. And the best thing you can do with like information about trading that is solid is to honestly and truly just blindly follow it. It needs to be trustworthy information, but the truth of the matter is, like, your personal experience, I would say, is like, it's very important. However, when you're building and understanding the foundations to trading, really just don't try to make it more complicated than what it is. Whatever they're saying like, just do it. Just add it into your strategy if it isn't already there. If you're doing something repeatedly and you see that it's not bringing the outcome that you want, then you need to evaluate that, whatever that may mean for you in that particular situation at that time. But most of the things that I've read from credible, I mean, pretty much everything that I've read from credible sources, I can almost blindly follow that information. Some things are very specific to the way a certain a person trades in particular, which those things you don't really want to go crazy trying to incorporate it into the way that you trade. But very black and white rules and just guidelines for trading, I would absolutely follow them and make sure that your trading strategy embodies it, because it's super important. And typically, if you've read a few trading books and they're all pointing out the exact same information about like the same thing, it's probably something you should listen to, in my experience.